Hey Cosmic Crew, welcome back to the channel. We are Cosmic, where we dive deep into crypto, finance, and the forces shaping the future of money. If you're tired of confusing charts, hype videos, and blind speculation, you're in the right place. Today we're breaking down the start of 2026 for XRP, and trust me, this isn't your usual pump and dump story. The first week of January 2026 kicked off with something extraordinary in the crypto world. XRP didn't just rise a few points, it experienced a structural shift that changed the digital asset hierarchy. While Bitcoin and Ethereum were struggling to maintain single-digit gains, XRP had already surged 25%. This wasn't driven by retail hype or late-night tweets. No, this was the re-entry of institutional capital into an asset that finally shed its legal uncertainty. Let's set the scene. For years, XRP carried an asterisk in brokerage apps. It was the token under investigation, the maybe safe option, the one that made investors cautious. But by January 2026, that asterisk vanished. XRP gained full regulatory clarity in the United States after the SEC settlement was finalized in late 2025. This wasn't just legal paperwork, it was a green light that institutional investors had been waiting for, and they didn't wait long to act. By January 6th, the numbers were clear. While retail traders were distracted by meme coins and AI projects, $1.37 billion flowed into XRP ETFs. That's not a casual pump. This is professional capital moving with precision. Unlike Bitcoin ETFs, which often see outflows during price drops, XRP ETFs had zero net outflows since their launch. Every day the money went in, and it kept going in, creating a structural shift in supply and demand. Think of it like this. The XRP supply on exchanges started disappearing. Tokens were being locked into ETFs and institutional wallets faster than the ledger could release new ones. This created a supply squeeze, which is why the 25% surge looked almost effortless. The market wasn't just speculating, it was recalculating the real value of XRP based on legal certainty and institutional demand. What's even more important is why XRP stands out compared to Bitcoin and Ethereum. This isn't about volatility or short-term hype. XRP is now the only large-cap digital asset with final regulatory clarity in the U.S., fully approved for institutional use. Banks and financial institutions can now use XRP for cross-border settlements without fearing legal issues. This is a big deal because it transforms XRP from a simple token into a core infrastructure asset for global finance. Before we move on, make sure to smash that like button, subscribe, and hit the notification bell. That way, you won't miss our next deep dive into the mechanics behind XRP's January 2026 surge. All right, let's go Cosmic. By the first week of January, we saw $1.37 billion flow into XRP ETFs. To put that in perspective, that's more than double the growth of Ethereum and triple the performance of Bitcoin during the same week. And here's the kicker. Unlike Bitcoin ETFs, which react quickly to market drops, XRP ETFs haven't recorded a single day of net outflows. Every day, the inflows go vertical, absorbing supply faster than it's released. This isn't speculation, it's strategic accumulation. Now, why does this matter? Think about the XRP supply on exchanges. When institutional investors buy and lock up XRP, the liquid supply available to everyday traders shrinks. Imagine a water tank. The inflows are like pouring water in, but if someone keeps taking buckets out faster than it refills, the tank starts to run dry. That's exactly what's happening here. Exchange reserves are hitting multi-year lows, creating a supply squeeze that naturally pushes prices higher. This is why XRP's 25% surge in early January felt so effortless. The tokens were simply being pulled out of the market faster than they could be replaced. The ETF accumulation acts like a vacuum, locking in XRP for long-term institutional use. Unlike speculative retail trades, which are temporary, these institutional positions are designed to stay. The market isn't reacting. They're restructuring portfolios around XRP. And here's the subtle but important point. This isn't about short-term profits. Institutional investors aren't buying XRP for a 10% or 20% gain. They're building core positions in the only digital asset that offers full legal clarity and regulated infrastructure for cross-border liquidity. This is why the ETF inflows are structural, not speculative. They are reshaping the very distribution of XRP in the market. Let's talk numbers. Institutional wallets, those holding over 10 million XRP, have increased their positions by nearly 40% since the SEC settlement was finalized. Meanwhile, retail holdings under 100,000 XRP are actually shrinking. This is the classic shift from retail to smart money, where supply is moving from the hands of many to the vaults of a few. The result? Less liquid XRP is available for trading, which amplifies price sensitivity and sets the stage for future spikes. And it's not just about the numbers. The mechanics of XRP distribution matter. Every month, XRP releases tokens from escrow contracts. In January 2026, 1 billion tokens were released. But guess what? 700 million of those were immediately returned to a time-locked contract, leaving only 300 million for operational and liquidity use. Combine that with the billions flowing into ETFs, and you have a perfect storm, a shrinking liquid supply facing soaring institutional demand. This is why the early January surge isn't random hype. It's a physical manifestation of market forces. Supply is being locked away while demand from regulated institutions grows. The market is finally catching up to XRP's true utility as a bridge asset for global finance. Unlike speculative tokens, XRP is being absorbed by players who will use it for large-scale transactions, not just hold it for short-term gains. Another point, this accumulation sets up a feedback loop. As XRP is locked into ETFs and institutional wallets, liquid supply drops. Lower supply plus increasing demand drives prices higher. Higher prices then make XRP even more attractive for institutions that need a deep liquidity asset for cross-border payments. This loop is why experts are predicting $30 isn't just hype. It's a structural requirement for XRP to fulfill its role in the global financial system. For years, XRP operated under a cloud of uncertainty. The SEC lawsuit labeled XRP as an unregistered security, creating a regulatory ceiling. No matter how strong Ripple's technology was or how many partnerships they signed, institutions were hesitant. The risk of potential legal action made XRP too dangerous for large-scale adoption in the U.S. financial system. Banks, hedge funds, and sovereign wealth funds couldn't justify exposure to a token that might later be deemed illegal. Everything changed in late 2025. The SEC settlement finally removed the legal risk. This wasn't a gray compromise, it was a definitive ruling. XRP was recognized as a non-security in every context: retail trading, institutional settlements, and on-demand liquidity ODL transactions. For the first time, investors could hold XRP without worrying about a future lawsuit or regulatory freeze. Why does this matter so much? Think of large institutions managing billions in cross-border liquidity. They don't speculate, they manage risk. And regulatory risk is one of the biggest threats in digital assets. The SEC ruling provided total finality, giving banks, hedge funds, and even governments the confidence to integrate XRP into their core infrastructure. Suddenly, XRP was no longer the outcast. It became the only large-cap crypto with a clean legal slate in the US. And this clarity triggered a global domino effect. Regulators in London, Tokyo, Singapore, and other financial hubs were waiting for the US to set the pace. Once the SEC settlement came through, these countries quickly codified XRP's legal status, making it fully recognized and usable across borders. Now, a bank in Dubai can settle payments with a bank in New York without navigating a legal minefield. XRP became the first truly borderless regulated asset. This global acceptance is why institutions are buying and locking XRP in ETFs and wallets. They aren't chasing hype. They are building a stable, long-term position in an asset that's legally safe, highly liquid, and globally recognized. The market isn't just pricing in the settlement, it's recalculating the role XRP can play in the entire financial system. Now, consider the impact on supply. Legal clarity removed the need for institutions to hold back. Instead of hesitating, they are actively acquiring XRP. The combination of ETF inflows, institutional accumulation, and decreasing exchange reserves creates the perfect environment for price growth. The 25% surge in the first week of January 2026 was not just a reaction, it was a correction of value. XRP was previously undervalued due to legal uncertainty, and now the market is correcting that mispricing. Let's also talk about the Ripple National Trust Bank. At the end of 2025, the Office of the Comptroller of the Currency granted Ripple a conditional federal trust charter. This was another major milestone. By becoming a federally regulated bank, Ripple can custody assets, operate payments rails, and issue its RLUSD stablecoin under strict supervision. This isn't just a technical upgrade, it's a structural bridge between XRP and the traditional banking system. Why is this critical for institutional adoption? Without a federally regulated custodian, major U.S. banks were reluctant to use XRP. The National Trust Bank solves that problem, allowing massive cross-border payments and central bank-level transactions. This explains why institutions are so confident buying XRP at scale. They now have legal certainty, regulatory oversight, and operational infrastructure all in one. XRP's January 2026 surge is powered by more than hype or speculation. It's built on legal clarity, institutional adoption, and regulatory trust. The market is finally pricing XRP as it truly is, a bridge asset for the global financial system. Welcome back, Cosmic Crew. By now, you know that XRP's January 2026 surge wasn't random. It's backed by institutional accumulation, supply compression, and legal clarity. But there's another critical piece: how XRP is being used in the real financial world, and why this is transforming it from a speculative token into a functional backbone for global payments. Let's start with the numbers. Every day, the XRP ledger now processes over 2 million transactions, a threshold that signals true adoption. This isn't pilot programs or test cases, it's high-volume, real-world usage. Banks and financial institutions are moving billions across borders using XRP as a bridge currency, replacing parts of the old, slow, and expensive SWIFT system. Why is XRP so effective? Traditional banking systems require trillions of dollars to sit idle in foreign accounts to facilitate cross-border payments. This is called the nostro vostro liquidity trap. XRP eliminates this problem. Banks can settle instantly, freeing up capital, reducing costs, and speeding up transactions. A single cross-border payment that might have cost $50 and taken 3 days through SWIFT can now cost fractions of a cent and settle in seconds using XRP. This efficiency is exactly why institutions are buying and holding XRP at scale. They're not interested in short-term gains. They're positioning for utility-driven value. And here's where supply-demand dynamics play a key role. The liquid XRP available on exchanges has dropped to a multi-year low. At the same time, ETFs and institutional wallets are locking up billions of XRP. This creates a scarcity engine. The less XRP available, the higher the price must go to meet demand. Now, combine that with the ledger's program token release schedule. In January 2026, 1 billion XRP were released from escrow, but 700 million were immediately time-locked, leaving only 300 million available for operational use. Meanwhile, billions of dollars are entering the ecosystem through ETFs. The result? Demand far exceeds available supply, which is a textbook setup for a sustained price increase. This is also why analysts are discussing a $30 target. It's not hype, it's math and operational necessity. To facilitate even a small fraction of global daily settlement volume, say 5% of the $156 trillion that crosses borders each year, the XRP price needs a valuation that ensures deep liquidity for banks and institutions. At current supply levels, that floor is approximately $30 per token. This isn't speculation. It's the minimum price required for XRP to serve its function as a global settlement tool. And it's not just numbers, it's structural adoption. With the Ripple National Trust Bank, XRP now has a federally regulated bridge for custody, payments, and stablecoin issuance. Institutions can move massive amounts of capital without legal risk, without liquidity constraints, and without delay. The system is ready for real-world scale, which is why institutional accumulation continues unabated. Here's another key point. This is a feedback loop. As XRP price rises, it becomes even more useful for large transactions. Higher price ensures deeper liquidity, which encourages more adoption by institutions, which further increases demand and drives price higher. The market isn't reacting randomly, it's self-reinforcing. XRP is no longer just a token people trade on apps, it's becoming the functional backbone of cross-border finance. The 25% surge we saw in early January wasn't the end, it was just the start of the repricing of XRP based on its real-world utility and structural demand. Welcome back, Cosmic Crew. So far we've covered XRP's January 2026 surge, institutional accumulation, legal clarity, and supply-demand mechanics. Now it's time to dive into the backbone of it all, the XRP ledger itself, and why its technical design makes it the perfect asset for global finance. Since its creation in 2012, the XRP ledger has evolved from a simple experiment into a robust, decentralized, and high-speed payment network. Today, it processes over 2 million daily transactions with 100% uptime, even through extreme market volatility. That's a level of reliability most cryptocurrencies and even traditional banking systems can't match. Reliability at this scale is a huge factor for institutional adoption because banks and funds need a network they can trust to handle billions in payments every day. One of the most powerful aspects of the XRP ledger is decentralization. Unlike some networks controlled by a single entity or jurisdiction, XRP validators are distributed across the globe. This means no single government or organization can shut it down. For institutions moving large amounts of money across borders, this is critical risk mitigation. They aren't just buying a token, they're buying access to a secure, resilient financial infrastructure. Velocity is another key metric. XRP's network doesn't just move money, it moves it fast. Traditional settlement systems like SWIFT require days to process international transfers, and banks need to tie up trillions in idle funds to guarantee liquidity. The XRP ledger completes most transactions in seconds, dramatically reducing the need for pre-funded accounts. This efficiency frees up capital and reduces operational costs, a major reason why $1.37 billion has flown into XRP ETFs and institutional wallets. Another technical advantage is XRP's predictable supply schedule. Unlike other cryptocurrencies where token emissions can be erratic or inflationary, XRP's monthly escrow releases are transparent and time-locked. In January 2026, 1 billion XRP were released from escrow and 700 million were immediately time-locked, leaving only 300 million available for operations. When you combine this with heavy ETF accumulation, you create a structural scarcity that amplifies price movement while maintaining network stability. The ledger also integrates advanced features like hooks, amendments, and sidechain interoperability, which allow it to support automated market makers, smart contracts, and cross-ledger settlements. Institutions can build sophisticated financial operations directly on the ledger without waiting for third-party solutions. This makes XRP not just a currency, but a fully functional infrastructure asset for the modern financial system. Here's the hidden truth. Cosmic Crew. While retail traders might focus on short-term price charts, institutions are looking at network reliability, liquidity, and settlement capability. Every high-volume transaction strengthens the ledger, and every ETF inflow or institutional purchase removes liquid supply from the market. This is why price surges are structurally reinforced, not just speculative spikes. The combination of legal clarity, institutional demand, and ledger strength creates a self-reinforcing ecosystem. Higher demand drives higher prices encourage deeper adoption, and deeper adoption strengthens the ledger's role as a settlement network. This is the feedback loop that could naturally push XRP toward the $30 structural target, not because of hype, but because of operational necessity in global finance. In short, the XRP ledger isn't just a digital token platform, it's a battle-tested infrastructure for international finance. Its speed, decentralization, predictable supply, and global adoption make it a rare asset that institutions can rely on. The ledger's capabilities turn XRP from a speculative investment into a core component of cross-border payments, a backbone for banks, and a critical tool for the $156 trillion global settlement market. Now that we've covered XRP's surge, institutional inflows, legal clarity, and the technical strength of the ledger, it's time to connect all the dots. The big question is, why is $30 realistic for XRP in 2026, and what drives it beyond speculation? Let's break it down step by step. First, the structural fundamentals. XRP's liquid supply is shrinking because institutions are locking up tokens through ETFs, wallets, and custody solutions at a record pace. Exchange reserves are at multi-year lows, while daily inflows from institutional capital continue vertically. This isn't a temporary spike, it's a long-term structural shift in ownership. Retail may take profits here and there, but institutions absorb every drop, creating a coiled spring effect in price. Second, XRP's ledger utility is now fully operational. Banks and financial institutions are moving real money across borders every day. The XRP ledger can process over 2 million daily payments faster and cheaper than SWIFT. This high transaction velocity, combined with the burn mechanism, a small amount of XRP destroyed per transaction, adds another layer of scarcity, signaling that XRP isn't just speculative, it's actively used. Next, consider the market size and math behind $30. To facilitate even 5% of the $156 trillion global cross-border settlement market, XRP needs a market capitalization of around $1.8 trillion, assuming roughly 60 billion tokens in circulation. That equates to $30 per token. This isn't guesswork, it's operational necessity. For large-scale payments, a $2 or $3 XRP token simply doesn't provide enough liquidity. Institutions need deep order books to move billions without slippage, and the $30 target reflects the price required to support real-world volume. Another key factor is Ripple's National Trust Bank. This federally regulated institution allows banks to custody XRP and issue stablecoins like RLUSD under regulatory oversight. That creates trust and confidence, which is why institutional adoption is accelerating. With legal clarity and infrastructure in place, XRP can now function as a global bridge currency. Every cross-border settlement reduces the need for idle fiat reserves and strengthens XRP's utility and demand. Then there's the feedback loop. As XRP's price rises, the network becomes more useful for large transactions. Higher prices ensure enough liquidity for big transfers, attracting more institutions, which further increases demand and reduces available supply. This loop is self-reinforcing, and it's what differentiates XRP from typical speculative altcoins. Price isn't just moving up because of hype, it's responding to real utility and structural requirements. We also need to acknowledge the human element behind the ledger. Ripple's leadership and engineers, including David Schwartz, have transitioned the platform from a founder-led startup into a mature global infrastructure provider. This ensures the XRP ledger can operate independently, survive market cycles, and support institutional and central bank-level settlements. Decentralization and global validator distribution further protect the network from single points of failure, making XRP a trusted backbone for digital finance. Cosmic Crew, the final takeaway is clear. XRP's journey to $30 isn't speculative hype. It's a logical outcome of legal certainty, institutional accumulation, ledger utility, supply compression, and operational requirements. The 25% surge in January 2026 was just the market clearing the deck, preparing for a multi-year integration cycle where XRP transitions from a traded token to a functional, globally adopted settlement asset. By understanding these layers, legal, institutional, supply-demand, and ledger mechanics, you see the bigger picture. XRP is no longer competing for retail attention. It's competing for the liquidity of the world's financial system. The $30 price point is not a dream. It's the floor required for XRP to function as intended, moving trillions in cross-border settlements efficiently, legally, and securely. So, Cosmic Crew, keep this in mind as we watch XRP's evolution. The next phase isn't about memes or speculation, it's about real-world adoption and structural growth. The plumbing of global finance is changing, and XRP is at the center of that transformation. If you found this deep dive useful, don't forget to like, subscribe, and check out the next video queued for you. Stay cosmic, and I'll catch you in the next exploration of the crypto universe.